accounting for partnership firm, and in this module we will be learning very interesting calculation. So your calculators and your mind should be there in doing this calculation, and that is how to calculate interest on capital. Okay, so that working for interest on capital would be based on the effective capital balance on an agreed rate of interest. Okay, so there would be a practice question in which we will learn that how we calculate effective capital balance. Please be attentive. So here we go. There is a practice question that January 1 X8 capital balance for partner A and B is 50,000 and 75,000 respectively. Okay, well, so on June 30th 2000 X8 means after 6 months. Okay, fresh capital was introduced by Mr. A, that was 20,000, and on August 31st means after 8 months fresh capital was introduced by Miss B, rupees 45,000. Okay, so calculate interest on capital at 10% rate of interest, and the accounting year is ending on 31st December X8. So the important dates underline: January 1 opening date, 30th June A introduced capital, and 31st August B introduced capital, and closing date is 31st December 8. So how we will work out effective capital balance for each partner? Well, partner A had opening balance of 50,000, and partner A introduced fresh capital 20,000, which remained in the business for 6 months till the date of closing, end of reporting period, which is 31st December. It is 6 months. It remained with us for 6 months. So 20,000 capital remained with us for 6 months means it is effectively equal to 10,000 rupees. So the effective balance of Mr. A's capital is 60,000. Got it? Great. Very good. Well, so now Miss B. Opening balance for her was 75,000, and she brought 45,000 as fresh capital at the end of August 31 on this date. Well, so this capital which Miss B brought in remained in the business for 4 months in this year till the date of closing. Okay, well, so its 4 months balance would be equal to 15,000 effective amount of capital. So the effective balance of Miss B's capital is 90,000. Got it? So fresh capital will be multiplied by the number of months from the date of introduction of capital till the closing date. Number of months from the date of introduction of capital till the closing date, which is 4 months. All right. So this is how we work out effective capital balance. Now we will apply interest rate of 10% on the effective capital amount, and the interest on capital for partner A would be 6,000, and for partner B would be 9,000. So this is simple multiplication of percentage with the effective balance of capital. Okay, and that's it. So this was very easy. This was a simple calculation of effective balances for capital, and we apply interest rate on the agreed rate, which is like already agreed in the agreement partnership deed, that is applied on the effective capital balances. So these are the 2 tips in this module. Thank you.